Dr. Wang is here recording in my basement. In this video clip, I'm going to talk about currency options. The currency options are just similar like stock options or bond options, except that the underlying assets of the options are foreign currencies like a British pound, Swiss franc, or Japanese yen. First of all, we should know that currency options provide the right to purchase or sell currencies at specified prices. Okay, it is not like futures and obligations where only obligations are applicable. The currency options provide the right to the option buyers, and the option buyer can have the right to either buy a currency in a call option or sell a currency in a put option. In contrast, futures and forwards involve no right but only obligations, no matter you are on the buying side or on the selling side of the contracts. For currency options, a buyer can choose either to exit the option or not. When the option is in the money, in that sense that when the buyer exits the option, they can make some money, they would choose to exercise it. If the option is out of the money, in other words, if the buyer exits the option, he or she would lose the money, then that buyer would not exercise the option, because if they don't exercise the option, they have a zero profit or losses. If they exercise the option when the option is out of the money or in a very unfavorable position, then they would ask for loss. Zero is better than a loss. So when the option is exercised, whoever sells the option at the first place would have the obligation to fulfill the trade. So for call option buyers, when the option is exercised, then the call option will buy the currency at a specified price, and then the call option seller would have to sell to the option buyers at that specified price. And we will talk more about this in later slides. So when the option is exercised, the currency is delivered. It's just the same as futures and forwards contract. So talking about the option markets, the option market is a little bit mixed. Previously, we talked about the forward market is more individualized, and the futures market are more standardized. And in the option markets, I said it's mixed because you have both the standardized option markets, you also have over-the-counter option market. Okay, over-the-counter market is more individualized, where currency options are offered by commercial banks or brokerage firms, and it is similar to the forward market. So let me zoom out myself a little bit or put it somewhere better. And for the standardized option markets, so you have many of these markets, like Amsterdam in Netherlands, Montreal in Canada, and Philadelphia in the United States. They all provide standardized trading of currency options. And also we have the CME group, which was merged into in the year of 2007. Prior to that, the CME was two parts. One is a CME company, and another is the Chicago Board of Option Trading, or CBOT. And of course, since currency options, just like stock options and stocks, these are securities, and they are regulated by the Securities Exchange Commission in the United States. So talking about the currency options and the CME, is a standardized market, so the trading is pretty standardized. So right here, you are looking at a specification of a currency option. The underlying assets is Australian dollar. You can see for each of these option, well, although it says a futures contract, but clearly this is for options. You see option is highlighted. The size is $100,000 Australian dollar, and the contract month could be March, June, September, and December. It could be a quarterly, it could be a bi-monthly, it could also be a 4-weekly. All right, and you can see some other information here, like the minimum size per Australian dollar. You imagine that multiplied by 100,000 Australian dollar. That's basically a $10 contract. So the price can only change by a $10 up or down times a integral number, like 10, 20, 30, 100, 250, something like that. Okay, and here it also specified the trading hours. Okay, so the terminologies for options. Here you should know when you sell an option, well, we can also call it write an option. It's the same as create an option. Yes, you can create an option. It's not like a stocks. Only the companies can create stocks by slicing its equity into small pieces of shares. In the option market, you can create an option or you can write an option. All right, we call it writing an option, and then sell an option. So write an option is the same as sell an option, is the same as create an option and then sell it. Well, if it is buy an option, we just call it buy an option. And we also have the price for options. Think about that. The option gives them a good thing, right? It provides the right to whomever purchased it or to the buyer, right? So the buyer has to pay for this right, to pay for this freedom to whether exercise the option or not. So the option comes with a price, and the price for the option is called option premium. There is also a strike price for the option. We call it exercise price as well. So the strike price basically is the specified exchange rate for the Australian dollar or for the Japanese yen in the option contract. When you exercise the option, so basically it means the buyer chooses to exercise the right to trade at the strike price or the excess price. Okay, so here are the important terminologies we use for this topic. And of course, an option contract is just like a futures contract. It has an expiration date. You can also call it maturity date. There are two styles of options. One style is called American options that allow option holders to access the option at any time prior and including its maturity date. And the value of the option to holders relative to European options, which can only be accessed at maturity, and the majority of the exchange traded options are American style. Well, the European style currency options must be exercised on the expiration date if they're not accessed at all. So you can see that the American style option provides much more freedom. You have a very long time span to decide when to access the option, whereas the European style option can be only exercised at a specified date. Well, some of you may ask why we call it European term, why we call it American term. I explained this before. We just use the European to stand for foreign, because 100 years ago when the financial market was developed, the only comparable foreigners in the financial market are Europeans, when the Japanese, the Chinese were not able to conduct financial trading at that time 100 years ago. Well, you can see that the European style option does not provide much flexibility, so it should also be sold at a cheaper price. So what do we call the price of options? We call it option premium. So the European option, since it's offering less flexibility or freedom, it can be purchased for a lower premium or lower price. And some of the corporations may prefer this European style option for hedging. Okay, and hedging is an activity to prevent the risk in foreign exchange rates. And the companies, the multinational corporations, need to do hedging if they have accounts payables or accounts receivables due in the future and also invoiced in foreign currency. For more details, we are going to talk it in Chapter 8. Now let's talk about the two options we have. We have a call option, all right, which grants the right to buy a specific currency at a designated strike price within a specific period of time. So first of all, call option is the right to buy the assets at a specified strike price. And you will face two situations if you are a call option buyer. Either the spot rate when when before the option expires go above the strike price, okay, then the owner or the buyer of the call option will choose to exercise the right to buy the currency at the strike price. Okay, think about that. If the strike price they choose to buy at is lower than the spot rate, which is higher, so they can buy at a lower strike price and then simultaneously sell at a higher spot rate, and then they can make a profit. If the spot rate drops below the strike price, then the buyer of the option, okay, should not exercise the right to buy the currency at the strike price. So what that means is if they ever exercise the option to buy the strike, well, you know that they will pay a price higher, and if they sell, they can only sell at a spot rate, which is lower than the price they pay. So they are only asked for a loss. For a rational trader, they would never do that. So the rational choice here is to not exercise the call option when it is out of the money. And you need to be aware that the buyer of the option always pay the premium. And here is the different status for a call option. So if the spot rate is greater than the strike price, then the option is in the money. So that means if you exercise the option, you can make some profit. Okay, as I said, when you exercise the option, that means the buyer of the option will buy at the strike price and simultaneously clear the position by selling at a spot rate, which is higher. If the spot rate equals to the strike price, then the option is at the money, so you are break even. If spot rate is lower than the strike price, then the option is out of the money. That means if you ever choose to exercise the option, you are making a loss, so you better not do that. All right, so just let the option expire or do nothing. We also have a put option, which is the other kind of options. So it grants the buyer the right to sell a currency at a specified strike price within a specified period of time. If the spot rate falls below the strike price, then the owner of the put option can exercise the right to sell the currency at a strike price. Okay, so if you want to sell a currency at a strike price, of course you want to sell at a higher rate, at least higher than the prevailing spot rate. Okay, so if spot rate is lower than the strike price, that's an opportunity for you to make money as a put option buyer. When that opportunity presents, you can sell at the strike price, that what it gives from the option, and then simultaneously buy at a spot rate, which is lower. So you sell high here and buy low here to make a profit. And of course, the buyer of the option always pay for a premium. Okay, so if the spot rate is lower than the strike price, then the option is in the money. So that means you are making a profit. So you can sell at the strike and then simultaneously buy at a spot to make a profit. If spot rate equal to the strike, you are at the break even. We call it at the money. If spot rate is greater than the strike price, then we call the option is out of the money. So at this situation, if you ever access the put option, you will need to sell at a strike price and then simultaneously buy at a spot rate to clear your position. Since the spot rate is higher than the strike, so you will need to pay a higher price, but to sell at a lower price. So that's a loss. You will not do that as option owner or option buyer. So you will choose to do nothing or let the option expire. Here, I open up an Excel file. I'll try to show you how the option works. So here we get a call option. Okay, you should know that a call option provides the right to buy, all right, and our underlying assets is British pound. Okay, British pound, and the symbol you can get from an insert symbol, and it's right here. Okay, so that's the sign of a British pound. All right, and let's say the strike price, we use X. X stands for exercise. All right, or just say a strike price or strike rate. Strike price in an option contract, the buyer of the option can buy 1 British pound at $1.2. Okay, $1.2 per pound. All right, and then they are facing several conditions. Okay, some possible situations. Let me just give you an example. The first situation, case 1, the spot rate, put it right here. Case 1, the spot rate is $1.5. Okay, so what's the status of this option? You will see the strike price make the buyer to buy is 1.2, and then the spot rate in the market is 1.5. So the pound is worth $1.5 when the buyers can buy at a cheaper price of 1.2. So the status of this call option is in the money. Okay, it's in the money. And what's the buyer's decision? Okay, the buyer's decision would be to exercise the call option. Okay, exercise the call option. All right, and then if the buyers choose to exercise the call option, then the writer action would be to fulfill the obligation. Okay, is to fulfill the obligation. All right, and you can also figure out the buyer's profit. The buyer's profit would be equal to $1.5 minus $1.2 per British pound. The buyer will buy at 1.2 and then sell at 1.5. The buyer would make a 0.30 profit. Okay, and then the writer of the option will have a loss. I just call it the writer's profit. If it is a negative, then it is a loss. So the writer of the option would be the exact opposite of the buyer's profit, or negative 30. Okay, it's a negative 0.3. Or you can put this way: for the writer or the option creator and the option seller, when the buyer chooses to exercise the option, the buyer will buy the option from the writer. Okay, think again. The call option buyer, when he or she exercises the right to buy the British pound, this buyer will buy from the writer of that option. Okay, so the option writer will need to sell. Okay, will need to sell at a strike price to the buyer. The obligation would requires the writer to sell pound to the buyer at a strike price. Okay, so the writer will be the counterparty for trading with the buyer. So the writer's profit would be when you sell, they would receive $1.2. The writer will sell to the buyer at $1.2, or the buyer buy from the writer at $1.2. And then the writer also need to clear his or her position by buying from the spot market at $1.5. So the writer would incur a loss. Okay, the overall profit would add up to 0. So that's one case. And another case, case 2, if the spot rate tends to be 1.0, okay, what do we call this status? If the option is exercised, then for the buyers, they would be losing money, okay? So the buyer will need to buy the strike, pay 1.2 when the British pound is only worth $1, so they will not make any money. Or if they choose to exercise it, they will have a loss. So this is called a out of money situation. Then the rational choice for the buyer would be no exercise. Okay, and then the writer will just do nothing. We just do nothing. And then for the buyer's profit is 0, and then the writer's profit is also 0. Okay, so far I have not incorporated the price for the option. When the option buyer from the option writer buy it, then the buyer needs to pay a premium or the price of the option. So that price is called a call premium. And we just I just put it as $0.1 per British pound. For each British pound, then the buyer would need to pay 10 cents. And it's not just 1 British pound we're trading at. Essentially, we are talking about 625,000 British pound per contract. Okay, so that's a large amount of size of one option contract. So if we incorporate this call premium into our calculation, you will see that it should always stay in the buyer's profit. The buyer always pay for the premium to the option writer. Okay, so that's always a negative part of the buyer's profit. And for the option writer, the profit always include the premium received from the buyer. Okay, so when the writer sell the option to the buyer, he or she would receive this 10 cents premium. Okay, and that's for case 1. For case 2, the buyer's profit, as I said, always include this negative premium, because no matter the buyer choose to exercise it or not, the buyer always pay for the premium. And the writer, no matter the buyer choose to exercise it or not, always receive the premium. Okay, that's how the game is played. And you also have a case 3. We call it in the money. Oops, the status is at the money, and in this case, the spot rate is $1.2. Okay, so the buyer decision would be a break even. The buyer can choose to exercise it or not exercise it. It's the same, and then the writer's action would just be doing nothing. Well, it depends. It's also break even. You can say that. And for the buyer's profit, it is whatever the call premium he or she paid. And for the writer's profit, it would be just the positive premium collected from the buyer. Okay, so that's a 3 status for a call option. And now let's work on a put option. So let me just copy paste the whole thing. Well, and I will let you make a contrast between call option and put option. So for put option, a put option provides the right to sell, okay, at a specified price. Still, we have the same term, same option contract, and same size. The strike price is the same, but the premium or the price of the option, instead of calling it call option, we call it call premium. We call it put premium. It's still this time make it 0.12. Right, and you also have three different cases. Okay, you also have three different cases. Case 1, the spot rate is higher than the strike. Case 2 is lower than the strike. Case 3, the spot is equal to the strike. So I also put all of this here. Okay. So for case 1, when the spot rate is at 1.5, so think about that. The call option buyer, the put option buyer here will exercise the right to sell at 1.2, and if he sell at 1.2, then with that a large amount of a British pound, he or she will need to buy at 1.5, a higher price. Would she or he do that? Probably not. So this is the case when the put option is out of money. So the buyer is decision just to not exercise the put option, and the writer's action is just to do nothing. Okay? For the buyer's profit, well, you know that the buyer always pay the premium. It's just the negative premium. It's have to be suffered. And for the writer, it's a good time for the writer. He or she just to collect this 12 cents. All right. In case 2, things are quite different. This time, the spot rate falls below the strike price 1.2. So that means if the option buyer chooses to exercise the option to sell, the option buyer will sell at 1.2. I know this sounds a little bit crazy. The option buyer exercises the right to sell. Okay, so the put option buyer will sell at $1.2 for each British pound, and then simultaneously clear the position by buying from the spot market. Okay, so that way the put option buyer would make money. So the status of the put option is called in the money. Okay, in the money, and the buyer's decision would be exercise the put option. Okay, when the option buyer exercises the put option, then what's the buyer's profit? As I always say, the buyer always pay the premium negative in the equation, and also the buyer will sell at this $1.2, okay, at this $1.2, and simultaneously buy at this spot rate of $1. Okay, so this is how much the buyer would make for profit. And the writer's profit would just be negative of the buyer's profit, which is negative 0.08. But I do want you to know what's the writer's action in this regard. So when the buyer exercises the put option, the buyer will sell, okay, will sell at 1.2 to the option writers. So the option writers would fulfill the obligation to buy at a strike from the buyer. Okay, so you can read this line of a description. So that's the writer's action. So that means the writers will pay $1.2 to the option buyer, okay, to get this large amount of British pound. And this option writer will clear the position by selling the British pound they just purchased. Okay, so when the writer pay this 1.2 to buy pounds from the option buyer, then the option writer also need to sell at the current spot rate, okay, to clear the position. And of course, the option writer would collect the call premium beforehand from the buyer. So that's a profit for the option writer, the put option writer. I would say the put option is a little bit harder than the call option. In case 2, it is definitely at the money situation because the spot rate right here equal to the strike price. So this is a break-even situation. The buyer may choose either to exercise or not, and the writer's action would also be break-even, depends on the buyer. So the best description here is to say this depends on buyer. Okay, so depends on buyer. So no matter the buyer exercises or not, they just have the same profit, which is a negative premium they pay. And for the option writer, it's the positive premium they collect.